Hello everybody and welcome back to the Cyclical Investors Club YouTube channel. Today I'm going to be looking at Charles Schwab Corporation stock by request. If you have a request for me to perform an analysis on a stock that's in the S&P 500, just drop it in the comments section and I will put it on my list, which is now on the whiteboard behind me. And I will eventually make a video analysis of it. I got a recent request for Charles Schwab, so I wrote on this back in April, so I kind of bumped it up to the top because I think everything I wrote in April still stands today. And I'll put a link to this article over on Seeking Alpha down in the description as well, since I'm just going to kind of skip through and highlight these 5 reasons that I don't think it's time to buy it yet. So, not to buy yet. As always, this isn't individual investing advice. This is just the way that I analyze stocks. In this particular case, the way I think about stocks when I look at them and why I would buy them or wouldn't buy them, or and the reasons behind that. If you have a stock that's not an S&P 500 you would like me to analyze, if you go over to Patreon, I post those requests over there. It's only $5 a month. And then if you decide to join my full Cyclical Investors Club service, you get a big discount. And I'll have all those links in the description. So let's get into the 5 reasons not to buy Charles Schwab yet. So I wrote this on April 11th of this year, 2023. And this was written right after this big giant drop that we had during the banking crisis. And a lot of people at the time were writing that Charles Schwab was super cheap and it should be bought. And then it seemed like, if I remember correctly, the other side were like, they have all these obligations and they're going to go bankrupt and you should move all your money out of Charles Schwab or something. And so I had totally different reasons for not buying it yet, even after the big fall. And I basically just wanted to explain those to people that weren't quite as kind of hyperbolic as the other bears, I guess. And it was a neutral article. I wasn't, I don't usually write bearish articles after the bear stuff has like really started to happen. I try to warn people ahead of time when they happen. I don't think I've ever written on Charles Schwab before this though. But I didn't even track it, and some of the reasons that I'll explain why are going to be in this article and in this video. So let's just get right into it with that kind of background. Oh, and the stock is just slightly below where it was when I posted this article. So it's still timely 6 months later or whatever it is now. All right. Let's just skim down quickly and we'll go to, okay, so the business is cyclical historically, right? So that means that if you're just looking at PEs, it probably wasn't necessarily cheap. Let's pull up a fast graph real quick. Maybe, if it loads. Come on, fast graph. I'm waiting on fast graphs. There we go. Okay. Not sure why it took so long. I had it preloaded and everything. Okay. So let's see. I was writing back in April. And back then, the PE would have been 13, all right, which people were saying, hey, that's pretty cheap. Earnings were at $3.90 a share. Now the PE is, or the price is about the same and the PE is higher. Hey, what's going on with that? Well, earnings fell, right? So that's what happens with cyclical stocks. And if you look back here to the Great Recession, you can see that earnings fell a lot. They also fell during COVID. Earnings are represented by this dark green area on the graph and the orange line for earnings per share. So if you look back to the Great Recession, peak earnings were $1.06. They fell all the way down to 38 cents. So like a 60-ish percent, maybe 65% decline off the peak. So at the beginning of this decline, this is the main thing that I was warning people about when people are like, oh, it's a 13 PE, it's super cheap. They've been around for 1,000 years and everything. So if you would have bought, right in here when it was about the same PE, that would have been at, actually that was already into the, that was actually into part of the crisis. You still would have had an initial decline of another 30%. And then you would have had, let's just say you bought here. But it wasn't over because the real bottom didn't come until a few years later. So you would have had 30% over 1, 2, 3 years later, still would have been down 30%. And the S&P 500 would have recovered by then, right? So you want to be a little careful buying on these initial dips. You might not get totally killed, but you also might be waiting a long time to get a good return. And so I want to buy when I'm going to get a really good return, or at least I have the probability of getting a good return. So we're definitely way off the peak here. It was pretty irrationally exuberant up here, and now it's down about 50%. So we've taken some of the froth out for sure, but it's not necessarily a buy because we can see that it can still take a while for the price to bottom and recover. So that was my first reason not to just kind of jump in and just say and think it's like the deal of the century. All right. Second reason, the historical recovery time is slow. So this is really important. Let's go. I went back to 2000 and showed, So the 2000 recession, it took, how many? 15 years to recover its old highs. This is the price high. So, from high to recovery, 15 years, a long time. And then in 2008, it took, let's see. I didn't write how many years it took, but I will look. 2008 to 2015, 7 years? 5 or 6 years. Here we go. So that's a long time. Now, if you buy it on the dip at some point, you're not going to have to wait as long, and it has dipped. So maybe if we go back and we were to look here, you say, okay, the poor folks that bought up here, they might indeed be waiting 15 years for a recovery. So the guys that are thinking about buying here are in better shape, but it still can take a long time for the stock price to recover and make really good returns, which is what you want. All right. Here's another interesting thing. The earnings for these guys tend to bottom late. So when you see the earnings price, let's shorten this a little bit. We have a down earnings year, and you might be tempted to say, okay, well, earnings, they had their bad year. Now they're going to do what analysts say, and they're going to come back 20% next year. If we have a recession, that is highly unlikely because historically, and again, this only goes back to 2008 recession, but I have it going back before too on my other graph. 2008 earnings, that was when their earnings actually peaked in 2008. And it took 2 years before they troughed. So think of it as like a lagging indicator type of a thing, right? The economy, their earnings are going to follow the economy and lag behind by like a year. So when the economy recovers, they'll recover later. When the economy kind of turns, which it really hasn't done yet, then they can turn. Now, when I say the economy, that's one thing. The market is, these guys are like a broker. It can be, the market can kind of be its own thing. So like a bear market can also influence their earnings, probably even more so than the economy. But and those can become a little bit disconnected. So let's see. So that's what the point I'm trying to make here is. That is what happened here. The economy has been fine. They just had GDP come out, and it was, I forget the exact numbers off my head, but it's really good. It's better than anybody expected. Now, these have been kind of like stagflationary reports until this last quarter, and I expect it to be pretty bad in the next quarter, like fourth quarter. Fourth quarter and first quarter aren't looking. I wouldn't forecast them to be great. So this decline in their earnings, well, it's related to like interest rates and banking and everything, but it's really related to the market as well. The market had a big decline in 2022, and if once you get outside of the Magnificent Seven, the rest of the market has kind of sucked. So their earnings are gonna be down, even if the rest of the economy is doing just fine, which it has been. But what happens is if the rest of the economy tanks too, then you're going to see another leg down. I wouldn't be surprised. I mean, if we had a bad recession, you could see 2 more years of bad earnings from these guys. Because we had this boom bust from the stimulus money. And then, if it's just a mild slowdown, maybe they have 1 year of poor earnings. I would be absolutely blown away if they grow 20% next year. Seriously, something special would have to happen. So I would definitely say next year's probably going to be not, lower probably. And then it's a question of how bad is the slowdown? Do we even get much of a slowdown? How much does that affect the stock market? And so there's a bunch of other questions you have to ask. But typically, these guys, their earnings don't really start falling until after the recession, right? They were well into the recession, and then they came down, and then they took a long time to recover. COVID, same thing, only quicker because we had stimulus, we had a recovery. So don't look at earnings as a leading indicator, would be what I would try to say there. And then if you're measuring down from the top, if you're like, well, it's down 50%, it must be good. Well, it was really super overvalued up here at 30, which I want to say, I probably wrote this in the article, but let's just check. I think this is where it was it wasn't even valued that high. So that was what, 27? They were like 20, maybe right here, 27. Okay, so they were valued the same going into this downturn as they were into 2008, right? And in 2008, the stock lost a lot of money. It went from $28 to $11 4 years later, at least 3 years later. So again, it's that delayed, kind of delayed downturn that you have to be kind of careful. The positive side is if you're patient with a stock like this, you can wait and see kind of how the downturn goes. You might not bottom pick it, but if you have cash left over after like a slowdown or recession, a bear market, whatever, then chances are this stock will still be beaten down and you can still have a chance to go buy it at a good price. I mean, you could have bought it in 2012. Let's just go almost 2013. Yeah. I mean, you could have bought it right at the end of 2012, held it up until COVID, and gotten 20% return each year. So you didn't have to pick the bottom in 2009, right? And that's the approach I would take for something like this. Rather than buying early and waiting a really long time for a recovery, look for other opportunities that are going to recover faster. I mean, you could have taken profit in some stocks in 2012, sold them, bought this one cheap, and then gotten another, 100 or 200% return over the next few years. So that's a better strategy with this type of stock if you want to buy it. And then inflation so this is what's happening now, right? Fed is holding interest, raising it higher than anybody expected, holding it probably longer than for anybody expects unless we have a recession, which is going to be bad. So in 2008 and 9, that wasn't the case. We had deflation. We had the Fed doing everything they could. Same thing actually in 2018. I mean, this is probably going to be Christmas. I can pick that out right away because that's when Powell came in, that bottom, boom. And they were falling again until interest rates changed. So if the Fed doesn't step in, and they did the same thing in 2020 on that bottom, so we have to recognize that this time is different. And the Fed, the Fed's probably only going to come in if we have a bad recession. So it's just not the same setup quite as it was in 2018 and it was in 2020 for the folks that had success coming in and buying then. So those are the 5 reasons that I would avoid this one. I would wait until after we actually have a real downturn before I decided to buy it. Thanks for watching. If you have any questions, put them in the comments. Have any requests, let me know. And I will make another video, and I'll see you guys later.